The Cure for Stock Market Crashes, a Survivor Guide for the Intelligent Investor, How I Survived. 1929. And my dear friends, please, settle down. I know why you're here. You want to hear what an old-timer has learned after navigating some of the wildest market swings in history? You all have that one question, don't you? When is the next crisis coming? Am I going to lose everything? The lesson from the Great Depression, price versus value. Let me tell you this. The cure for your anxiety about market crises and crashes is not to precisely predict the date of the next collapse, but to learn to accept it. You see, the market is like the weather in New York volatile. A crash is not a risk. It is a cycle, an inherent part of the market mechanism, as natural as gravity. Your anxiety stems from focusing on the fluctuations of the price instead of the value of what you own. My friends, the only way to eliminate that anxiety is to completely clarify who you are. Are you an investor? Or are you a speculator? Let me share a story with you. A tale of greed and fear. A story I lived through myself. In 1929, people believed they had discovered a perpetual motion machine. Stock prices detached from all rational basis, and the dangerous scent of this time as different permeated Wall Street. Even as an experienced fund manager, I wasn't entirely immune to the shock of that disaster. The Great Depression was an expensive education, but it fundamentally established my investment viewpoint. Always separate price from value. In that catastrophe, I watched countless so-called investors go broke overnight. But did they truly go broke because of the market? No. They went broke because of speculation. Take casino versus the corporation. Speculator versus investor. The essential nature of Wall Street is to provide capital for businesses and facilitate investment. But it also operates a massive casino that caters to the speculator. The speculator is chasing a quick profit. They buy and sell based on charts, rumors, and hot trends. Their buying rationale is, I hope it goes up, not, its intrinsic value is worth this price. They are slaves to market emotion. When the market is excited, they buy optimistically. When the market is fearful, they sell in a panic. And most of you, when crisis hits and you feel panic, it is because you have unintentionally become a speculator. You have never asked yourself, what is the actual worth of the company I just bought? Well, friends, listen closely. There are the speculator. Their main focus is predicting market swings and profiting from them. They're not buying a business. They're buying a lottery ticket, a bet that the price will be higher tomorrow. Their protection is hope and luck. The intelligent investor, their main focus is analyzing the fundamentals of a company and seeking adequate and stable returns through conservative principles. They are buying part ownership of a business. Their protection is the margin of safety, which we will discuss next. Intelligent does not mean high IQ. It means being disciplined, patient, and willing to employ an analytical mind. When you start analyzing financial statements and value, instead of focusing on daily quotes, you take the first step toward intelligent investing. Market psychology. Dealing with Mr. Market. Imagine you own a private business with a partner named Mr. Market. Mr. Market is an extremely manic depressive fellow. Every day, he visits you, excitedly shouting absurdly high prices for your stake, or tearfully offering to sell you his share for an extremely low price. When Mr. Market is manic, he offers a ridiculously high price. When Mr. Market is panicking, he offers a temptingly low price. And every time a crash occurs, Mr. Market is at his most hysterical, most fearful low. Speculators are terrified and sell at any price. But what is the job of the intelligent investor? It is not to follow Mr. Market's mood, but to utilize his mood. When Mr. Market is frantically trying to dump his shares at a price far below their intrinsic value, you should quietly buy from him. When he is ecstatic and offering an overvaluation, you consider selling. Remember, your discipline and rationality are the best weapons against Mr. Market's emotions. The engineering of investment. The margin of safety. If Mr. Market is psychology, then the margin of safety is engineering. The definition of the margin of safety is simple. To buy a security at a price significantly below its calculated intrinsic value. Imagine you are building a bridge. A good engineer calculates the maximum load the bridge needs to support and then designs a bridge that can support 3 times that load. That extra 2 times the capacity is your margin of safety. In investing, it serves 2 purposes: guarding against error. We are all fallible. My valuation calculations might be wrong. The margin of safety provides a buffer for my analytical mistakes. Guarding against misfortune, businesses can encounter unforeseen recessions or industry difficulties. The margin of safety provides a buffer for poor business performance. If I value a company at $100, I would never buy it at $95, because that is too close. I will wait until it falls to $60 or even $50 before I consider it. The margin of safety allows your portfolio to still yield an adequate return, even if the business performs poorly. It is the ultimate defense against severe error, and the most fundamental distinction between the intelligent investor and the speculator. Know thyself. Defensive versus enterprising investor. Not everyone has the time or inclination to be a full-time analyst. Therefore, I categorize investors into 2 types. The defensive investor. This person seeks simplicity and ease. They build a diversified, low-turnover portfolio focused on high-quality holdings, or simply invest in broad market index funds. Their return may not be the highest, but it will be the most stable and reliable. Their goal is to avoid major mistakes. The enterprising investor. This person is willing to put in substantial time and analysis to seek out securities that are undervalued, neglected, or distressed by the market. They are seeking returns that outperform the average. This requires greater discipline and analytical skill. You must be honest with yourself. How much time and knowledge do you possess? Most people, if they can be good defensive investors, have already surpassed the crowd of speculators. Do not try to operate outside your circle of competence. The crash has an opportunity, not a risk. I must constantly repeat this, as it is the foundation of all understanding. Price. The amount of money you pay for the stock today. It is determined by the market and is full of human emotion. Value. The true worth of a business. It is determined by fundamentals like assets, earnings, power, and future prospects. During a crisis or a crash, the gap between price and value will reach absurd proportions. This is the speculator's nightmare, but it is the intelligent investor's feast. When you see a good business being sold at half its intrinsic value, what you possess is not a risk, but a series of opportunities. My dear friends, true investment success depends on your character and discipline, far more than your intelligence or luck. A crash will never cause you anxiety. As long as you thoroughly understand what you own, know you bought a business, not a ticker symbol. Adhere to your margin of safety. Always leave room for the worst-case scenario. Treat the market as your servant, not your master. Make Mr. Market's emotions work for you. Finally, remember this. Your financial fate depends on your own behavior, not on the performance of Wall Street. In the market, your greatest enemy is not the bear market or the bubble, but your own inner fear and greed.